Arthur, thank you very much. Thank you very much for the invitation. This is my third year in a row chairing the finance panel, and I'm very honored to be here. Very interesting when I'm actually half Macedonian from my father's side, so it's a homecoming of sorts. The format we'll have today is we're just going to introduce ourselves quickly, just our names and our organization, our titles and our organizations, and then it'll come back to me, and then I'll do a short presentation, just an overview on where we are, and then I'll just hand it off to each person, and they'll do their own presentations. We're going to try to keep questions to 3, and let's try to do it that way. It's going to be a tight session. I think it's going to be very interesting. As I told the panelists, I've been doing this for 20 years. It's the best panel I've ever been on, so hopefully we'll share some information with you. I'd say right now we're in a pretty good spot in terms of the sector. There's a lot of challenges from fintech. There's a lot of challenges, surprisingly, from marijuana company. Very interesting statistics. In the first quarter of 2018, there was more trading volume by dollars in Canada for marijuana companies than there were for the top gold producers. That's our competitors. Those are spec stocks, and so M2 Capital doesn't invest in those because we don't agree with it, but interesting. So we're in some very interesting times, and especially for the people out there that are involved with the companies that are looking for financing. If you have a good asset, you can actually finance it in the smart market. First quartile, second quartile, you'll finance it. Third quartile, good luck. Fourth quartile, thanks for coming in.
Thanks so much.
I'll hand it off to Bert, and then just please your name, your title, and your organization.
I shall do so. Thanks a lot, Rob. My name is Bert Koff. I'm a partner in the Dynamic Capital Mining Fund. Dynam is a natural resources-focused private equity firm that originates in the Harvard commodity investment arm. So we've to date invested $1 billion in mining.
Thank you. My name is Francisco Fortuny. I am a principal banker at the Natural Resources team at EBRD, European Bank for Reconstruction and Development. We're looking to mine financing, oil and gas.
Good afternoon, everyone. I'm Silvia Manissano. I work within the primary markets team at the London Stock Exchange, and I'm here today to talk about how mining companies can raise capital through London Stock Exchange.
Hello, my name is Yulia Shiripanova. I'm a project geologist and research geologist in Wardell Armstrong International, responsible for business development in this area in Russian and CIS areas. And we'll speak about technical reports which you need to publish your company for IPO and raise money there.
Good afternoon, Konstantin Zhitkov from Societe Generale. I'm part of Metals and Mining Finance team, and today I will speak briefly in 10 minutes about financing options for the companies in metals and mining industry, and also about our experience in the region and in the country. Thank you.
Good afternoon, my name is Zoran Martinovski. I represent IFC for Macedonia and for Montenegro, soon to be based in Belgrade. I'll be presenting today the IFC Global activities in the mining sector and some takeaways from our 50 years long experience in financing of mining projects. Thank you.
Great, thank you very much. Thank you very much for joining us today. If we could start with the first presentation, please. It's a short presentation. It's all visual. I was a mining analyst at Alpha Bank in Moscow, not Crete Bank in Moscow, and I always had this report called By the Numbers. The numbers just speak for themselves. So if we could start with that one, please. Great, thank you very much. Slide 2, please. And again, I'm just going to go through these slides. They're very visual, just to set the pace here. And if we take a look here, so all these slides come from a Pricewaterhouse presentation called Mine 2018 that was released early last week. And it's about a 10, 12-page report. If you go to the website, the Pricewaterhouse website, it's on there. It's free. It's an outstanding report. Incidentally, I started my career at PricewaterhouseCoopers in Toronto, my public career, and I finished at PricewaterhouseCoopers in Moscow. And so very quickly, if you look at market capitalization, we peaked back in 2010, and that's not actually, that's factually correct, but the market peaked in May of 2011 when the Glencore IPO occurred. Those guys are traders, they knew when the market was peaking, and they basically timed it perfectly. Actually, Stan Barty of Forbes Manhattan sold Consolidated Thompson for $4.9 billion in May of 2011. That's an asset he acquired for about $20, $25 million 4 years before. The initial return investors was 7,700%. If you pick the right assets, you can make a lot of money in this sector, as will show to us. So next slide, please. These are the financials. If we take a look, we're not that far off the top in terms of revenues. Those are the bars. We saw the highest numbers early in this decade, but we're not that far off. What's interesting is the CapEx did peak back in 2011, and if you look at the EBITDA margins are almost half of what it was 4 or 5 years ago. Next slide, please. This just shows inflation, where we are. Again, it peaked again in 2017, and it's been easing off. That diagram would be very different if it was in Russian rubles. You would just see a collapse in your input costs in 2014 as the oil price collapsed and the ruble devalued. Next slide, please. Again, CapEx, we had a build up, and then we saw a peak in 2013 of roughly about $125 billion. We're less than half now. And unfortunately, the mining sector is counter-cyclic. It actually invests as you go to the top of the market, because that's when banks lend you money, and so the market peaks, you're still building. It takes you a number of years to build a mine. You've already committed, if you've already built 30% of it, you got to complete it. And so you have this lag factor, and I think now, finally, after 100, 300, 500 years, you're starting to see discipline in the market, and hopefully Constantine will address that, Constantine from Société Générale. Next slide, please. Again, just the gearing ratio. The gearing's been roughly 30%. We're back to where we should be. That's actually a very reasonable gearing ratio. Again, it peaked 2 years ago. You're seeing across the board, from Barrick to Newmont to the Russian steel producers to ArcelorMittal, everyone's been paying down debt. So you're paying down debt in a low interest rate environment. Again, counter-cyclic or counterintuitive. Next slide, please. This is the hard one. Free cash flow and dividends. I'll just let it speak for itself. Thank you very much. I'll hand it off to Bert. I won't take any questions because that's meant to be an introduction. So I'll hand it off to Bert. If we could keep it to 3 questions at the end of his presentation, and then we'll move on.
Thanks a lot, Rob. Welcome, ladies and gentlemen, for our talk on funding options for mining entrepreneurialism in Central and Eastern Europe. I hope I can keep my presentation exciting enough to keep everybody awake after lunchtime. Now, while we are going in this presentation, we are going to compare very systematically the various funding options that are out there. The focus of this presentation is, however, on private equity. So, first of all, what is private equity? As the name implies, it is private money that is used to execute certain business plans, unlike the public market. So we're not talking about public market money here, which we're going to talk about later when the lady from the London Stock Exchange speaks. So this is private equity. Now, private equity is not a homogeneous financial product. There are lots of different funds out there, and every fund got their own strategy. So what I'm doing here on this slide is I'm simply summarizing the 4 main strategies that exist today in the mining private equity world. Number 1 is there is a back management team approach. What is that? That means a fund selects a management team before they have the assets, provides the team with the capital to acquire the asset, and then once the fund, through the management team, has acquired the assets, value is created either by bringing the asset into production, or by expanding existing production, or by expanding the reserve life. And afterwards, a liquidity event is initiated where the company is being sold to the highest buyer, and then the investor, the fund, and the management team are basically distributing the proceeds the profits amongst themselves. This is an unusual investment model in metals and mining. It is, however, the predominant oil and gas private equity investment model. So under that model in the US, approximately $100 billion of private equity capital get deployed in oil and gas. The second strategy that you find in the metals and mining private equity space today is a buyout strategy. These are typically the large generalist private equity firms like Carlyle, KKR, Apollo. They have their own in-house technical teams. They go after really large projects like 500 million, $1 billion buyouts, and usually use a lot of leverage to do that. I would argue not a lot of those deals have happened, and that's because the opportunity set for these types of transactions is actually very small in reality. The third strategy that you find in this space is what's called invest into project. That was until recently the most common strategy, where basically a private equity firm takes a minority stake in a private project or in a listed company. And then with that capital, the company makes its next value creation step, like either write a feasibility study or complete an exploration program, etc., etc. Funds representing that investment model have found it pretty difficult over the last 2 years to actually raise subsequent funds, because when the mining super cycle ended, a lot of capital invested under that strategy was actually lost. The fourth model that you find, which is also a very successful model, is typically over the last 3 years, 4 years, there have been a number of royalty and structured debt funds emerge. Some of them are quite well known to some people here in the audience, where basically some high-yielding debt is provided along with some royalty financing, along with some offtake agreements to actually fund primarily the development of projects. So it's 4 different strategies. When you want to address your financing needs in your businesses and your ambitions, it's very important to understand which fund represents which strategy so that you don't waste your time. So how much private equity is there out there in mining? The answer is actually not a lot. Given that this is an industry that it has a revenue base of about $2 trillion, you basically look at $21 billion of assets under management and approximately still $6 billion of still deployable capital, which sits on funds books that can still be used today to be invested into the metals and mining industry. So it is a relatively small pool of capital compared to the size of the mining industry globally. And the reason why there's only a relatively narrow pool of private equity capital in mining is because it is a pretty risky industry. So if you look past all the hype and all the promotion that you have in the public equity markets, where everything is great on the bottom quartile of the cost curve, in reality, there's not that much money out there for metals and mining financing today. So this here really compares how metals and mining private equity compares, for example, to oil and gas private equity. This little green line that you see on top of the chart here is actually the metals and mining private equity money out there. If you see, I mean, it is only a very, very, very small percentage of the total natural resources private equity space that exists out there. These numbers do not only include the mining specialized private equity funds, but also include co-investment pools, family offices, in the money that's invested by sovereign wealth funds. So that's all included in those numbers. There's a lot of entities out there who say they are going to invest in mining, but there's actually not a lot of entities out there who actually do invest in mining. Okay, so how does private equity compare to other sources of funding? All of you will get the presentations afterwards, so I don't go in every single detail here. But I want to make a little bit of a compare and contrast to the public markets. I hope the representative of the LSE is not going to be too pissed off with me about this compare and contrast after that. So where we argue lies the advantage over the public market is you just do not have to spend time on investor relations. So I typically ask every CEO who runs a junior listed mining companies, what percentage of your time do you have to spend on investor relations, on public company, corporate compliance, blah, 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 all of that. For junior mining companies, the answer is typically between 50 and 60% of management time. Now, I as an investor argue this 50–60% of the time is time that is not spent on actually executing the underlying business plans, on actually creating value in the business. So every day where management teams run around and attend all various conferences, frankly speaking, is time where value is actually not created in the assets in the ground. The next thing is, of course, as a private equity firm, companies that are funded with our capital, they do not have to disclose information. So when you list a company, every single time you got a positive drill hole or a good metallurgical test result, you're going to put out a press release, and because that's what the law requires you to do. So basically, you are basically telling half of Perth and half of Vancouver where they should come and pick up the ground around you. Now, we're not in the business of educating our own competitors. We actually believe in value creation actually under the radar screen, which in many cases is much better. And then the other thing is private equity money is available irrespective of market conditions. So especially in a market where the public markets are shut, as was the case in 2015, 2016, is actually the time where actually some of the best business plans can get executed, because that's actually the time when actually ambitious management teams can actually go out there and actually acquire projects and develop them. There is no better, as Rob said before, the industry is counter-cyclical, so people build projects when they should not be building them, and they buy companies when they should not be buying them, right? And what actually private equity enables you to do is, because the money is available irrespective of the public markets, that actually mines can be built when they should be built, and companies can actually be acquired when they should be acquired, namely at the trough of the cycle. So I don't want to bore you all with market statistics, but here's a few fun facts that are actually quite interesting. The chart on top shows the ratio of development capital that is required to build the projects over the market capitalization of the companies that actually own those projects. And it's actually quite an interesting chart. So the junior miner average, and junior miner, that's ASX, TSX and AIM market in London, the junior miner average is an 8 times multiple. That means the companies need 8 times more capital to develop their projects than the companies themselves are worth on the stock market. So that of course means that hardly any of these projects will get developed, because even in the unlikely case that most of those companies succeed in raising the capital, the dilution would be so punitive that the boards are anyway going to vote down the funding proposals. So there's a universe of financially stranded projects out there. Now, as is usually the case in at least the juniors, 95% of them are not worth even looking at. But you know, in between the many, there's sometimes a few that are actually worthwhile funding. The chart below is also quite interesting. By the way, these are not our own numbers. These are all kind of numbers from all sorts of accounting firms that audited numbers. Actually, all the capital, all the equity capital that has been raised last year in the mining industry globally, what has it actually been used for? And it's actually quite astonishing. Less than 10% of the money has actually been used to actually develop the projects. Now, naive me, being for 10 years a fund manager, I thought that's actually what mining companies should be doing with investor money, developing the mines and the projects. Almost 30% of the money went on to corporate purposes, listing fees, boards of directors, blah, 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 all sorts of things. So it's actually quite a significant number. 1/3 is being spent on acquisition, and then another 1/3 is being still spent on debt reduction. So now, there has been a selective recovery in the market recently. It's been primarily confined to metallurgical coal, gold and zinc, but let's not forget there's quite a significant number of commodities out there today that are still trading at the 10-year low, basically. I mean, you go to potash, phosphate, uranium, platinum. There's a lot of metals and minerals out there today that, as of today, we're sitting here still at a 10 or 15-year low, where there has been no whatever recovery. Okay, now, I've been talking a lot about the conceptual. I just want to make it a little bit more tangible with 2 or 3 case studies that I quickly want to walk you through. So Octus Chilago. Octus is an Australian base metals platform funded by us. When we started with those guys, they didn't have any assets. They had a pretty good track record of developing and operating polymetallic base metals assets in Queensland, in the Northern Territory in Australia. There was a great time in the market, like 2015, a lot of distress. The zinc price was very low, as you will all remember. And there was a mid-tier Australian zinc producer that went into insolvency, and we backed that management team to actually acquire a portfolio of 3 previously producing zinc mines and 6 development projects from the administrator. Assets were acquired, 2 of them successfully brought into production. So what was the edge here with private equity? because we underwrote this on an unlevered basis, we did not need any project finance, and that's key. Because project finance sometimes can come with quite a lot of punitive terms that actually undermine value creation, right? The bank typically wants you to enter into offtake agreements. Well, the offtakers know when you actually need an offtake agreement to unlock the funding. So you will get much worse terms than if you go there to the offtaker and say, you know what, I don't need you for bank financing because we're already fully funded. It gives the negotiation a completely different spin. Or, for example, the banks want you to appoint an EPCM contractor. Well, that typically adds another 10–15% to development capital. Because we are private, we can do what we want. So we said, okay, our management team is competent enough to subcontract themselves. We don't need that and can easily shave off 10–15% of our capex. Banks want you to hedge. Well, I mean, it would be crazy to hedge on the evening of the largest zinc-up market in almost a decade and give that value away. So there's all sorts of things that other funding sources want you to do that, for example, you would not have in private equity. And we made the calculation that if we had given in to the demands of other funding sources like project financiers, we would have lost more than 1/3 of the value of the whole business. Another interesting example here is Pembroke is a metallurgical coal platform that we back in Australia. That team ultimately succeeded in acquiring the 3rd largest hard coking coal reserves in Australia after a 2-year strategy to actually wrestle those assets out from the previous owners, which was a very large US coal company that had a very large footprint in Australia. Now, there's no public company with who entrepreneurs can pull that off, because in order to engage with the counterparty, you need to have the certainty of funding. There are not many pools of capital out there that would have the patience to basically see you through a 2-year period where salaries are being paid, business development costs, to actually wrestle those assets out of the current owners. And it was a pretty good day, so we acquired ultimately for $90 million something when the metallurgical coal price was at a 15-year low, where the price expectation only 3 years before was $600 million. Another quick example, again from the world of zinc, our Northwestern Canadian base metals platform acquired that from a listed Chinese company who got the community relations in Northwestern Canada really wrong, and they had the project almost 100% debt funded, which is not a very good funding mix for the mining industry. Went basically into default of all the debt covenants. They couldn't get into production for community issues. So the team that we back, that obviously knew these communities very well, those of you who know me will hear me say very often, we only back local teams in their own backyard, because we strongly believe local teams have a strong advantage over outsiders in terms of privileged access to information, privileged access to opportunity, the better ability an outsider to actually address local challenges. So they were able to cut a deal with the community that was the heart of the problem here for the Chinese majority owners, and ultimately ended up acquiring for $15 million a zinc mine that was 80% complete, that the previous owners had spent $200 million on. Was brought into production 9 months and was sold half a year ago. And last example again, a Chilean copper platform who we back again. We back all these teams before they have the assets, based on the track record in the past to secure and develop those assets. And so they assembled a very strong portfolio of copper projects in Chile. So we're well on our way of building a $100 million EBITDA business in Chile. So I was just deliberately going through my presentation a bit faster, just to make sure there's sufficient time for questions and proper time for all the other presentations. I just quickly pause here and take the 3 questions that you're allowed to ask according to law.
Could you please raise your hand if you have a question?
That's sufficient. I thought that's one.
And there's a microphone coming too. Could you please introduce yourself, your name, and what company you're with?
Gennady Agras from Sumitomo Corporation. So thank you for the presentation, it's very insightful. Just to touch a bit on geography in terms of where private equity is, because there's some, for example, geographies which private equity is trying to avoid, my understanding is. So for example, where do you see a gap geographically in terms of where private equity is basically at the moment?
Okay, well, great question. Obviously, it depends from fund to fund. Yeah, I mean, there's no universally applicable answer. Now, obviously, all the private equity money in the world, almost all of it comes from the US. So obviously, there's some constraints regarding countries with the US has a very bad relationship. But if you put those aside for the moment, I would say it's a portfolio construction, a risk-return question. Portfolio construction, obviously, you got to make sure that the significant majority of the portfolio is what's generally referred to as safe, low-risk countries. Yeah. And then from a risk-return equation is, yeah, when you invest in a country that has genuinely an elevated risk profile, obviously the return got to be higher. I mean, all of that sounds like corporate finance one-on-one, but that's how it is. Now, it's interesting, of course, what does country risk really mean in metals and mining, yeah? Because, I mean, you can have, we had tax surprises in Australia, for example, which everybody would quite readily argue is a low-risk country, but you had tax surprises in Australia with the super tax that easily wiped off 20% of the net present value of some projects, right? And if you
try to get a mining license in the U.S.
Yeah, absolutely. In the US, you had for quite a while, under the Obama administration, an open pit coal mining ban. Yeah, so everybody who was having a coal project and was looking to get it funded, yeah, and if it happened an open pitable coal project, all of a sudden found themselves with an asset that was exactly worth zero overnight. So you know.
I would just add to that an incredible example, which is Extra Resources, the ex-Xstrata guys. Yeah. They had $4 million of dry powder. They never pulled the trigger. They shut shop about 2 years ago, which means had they invested between 2009 and 2012, they might have done IRRs of 50, 60, 70, 80%. Yeah, they never pulled the trigger.
So country risk is quite an interesting debate because a lot of countries have a bad reputation, but sometimes the reality is actually much better than the reputation. Did it answer your question? I mean, I would say there are no real no-fly zones. Yeah, I mean, there are some obvious places where private equity wouldn't invest, like whatever, Afghanistan or Somalia or so, right? But apart from that, it really comes down to risk return and on the fund's individual appetite.
I would argue actually Southeastern Europe is becoming the mining region of Europe, and probably the next mining region globally. If you look at Nefsum with Lundin and Sun, Stan Marty's company, they made a $1.6 billion Canadian bid 2 weeks ago.
Oh, absolutely.
An upgraded bid, but people are starting to pay attention to this part of the world. And people don't realize this. In Soviet times, this region was very metal rich and metal producing.
Capital goes where there's the right opportunity. It's that simple.
We have a second question here. Hey, let's try to keep them to 2 minutes, though, the answers, because...
Ros from the UK Department for International Trade. I wondered how you feel about risk. In this region there seems to be a lot of feeling from the local community that mining isn't the best thing for Macedonia with environmental and social concerns. How do you deal with that sort of risk?
Again, I don't give a country-specific answer, I give a generic answer. Again, it depends on the circumstance, right? The other countries where you've got community sensitivities, like in Peru where we invested, right? Honestly, it really depends on the management team's ability to run the right engagement with the community and to de-risk it from that point of view. And obviously, if a project causes a real, genuine issue, yeah, environmentally or socially, then there's no project.
I actually have a rule for that, which is I tell the CEO of the company, build a school. Fund the books, pay for the books, and then pay for the uniforms for the children. The children will go home and tell their parents, this is a good company. The future of this world is education. It's very simple. We're going to stop there. 2 questions. We'll move on. Francisco, if you could start your presentation. Bert, thank you very much. All these will be posted on the website. We'll be sending out an email in the next week or 2. So, and I believe we'll also be posting videos.
Okay. Hello, everybody. Hello, everybody.
My name is Francisco Fortuny. I'm a principal banker at the European Bank for Reconstruction and Development. Some of you might know me already. We have here some clients and some potential clients, hopefully, as well, and some stakeholders with whom we have engaged in the past. My presentation today is not so much about financing opportunities or project finance or capital financing itself. It's more about what else could be done. I mean, what else can banks like mine, the European Bank for Reconstruction and Development, help to do in this particular region. So here's a small, short overview of the presentation. We are going to touch a bit on about the role of EBRD, what mining represents for us, and also what type of investments, investments with a green or inclusive component we can do. The next slide is an overview of our bank's general portfolio. I mean, we are a large investor in many countries across our region of operations. Namely, we are, I think, the largest single investor in Macedonia at the moment. Our focus has always been rather private. We try to mobilize FDI. We try to mobilize investment into our countries of operations. We are not owned, and that's maybe one of the most important details of this slide, we are not owned by private stakeholders. We are owned by 66 countries. So countries like Macedonia are represented in this bank, and this bank carries out investments for the benefit of these countries, of its own shareholders, plus the donor countries. We have a very large portfolio at this point. We have a track record of 5,000 projects in the region, and we have invested, last year, close to 10 billion across 412 projects. I want just to draw your attention to the region, and in particular, the Tethyan Arc, the Tethyan Gold Belt. I mean, you can see that there is a very interesting overlap between our region and what is one of the most prospective areas in the world. And I fully second what my colleagues have said. I mean, this is an area where mining can play a huge, very important role. And it's already playing a very important role in many of our countries of operations. We have basically mandates to operate in, across the Balkans, as well as Greece and Turkey, all of which are touched by the region of our interest. And just an overview of the portfolio of EBRD. I was talking at the beginning, the mining portfolio, sorry. I was talking at the beginning about the number of projects we have done. We have done about 5,000 projects, but we have only done in 25 years 56 equity and debt projects in the mining sector. That's quite remarkable, I mean, because this shows there is maybe something going on in the way we assess or we choose or we select projects. Also, in terms of volume, we have only invested about 2 billion, which is the same amount we have invested in Macedonia so far in this particular sector, in the mining sector. And there are two reasons for that. One is a natural reason. Another is maybe a more moral or ethical reason. The natural reason is, well, there are not many investable mining projects around. It's difficult to come across opportunities that tick all the boxes for our engagement. And I just would like to also, one of the things I would like to take away from this presentation is the fact that we are a very selective type of investor, and we are also aware that only one every 1,000 projects that start prospection, meaning rock chip sampling, initial drilling, can reach to the development stage, can achieve the mining finance stage. So in terms of minerals, we have worked primarily with copper and gold. That's two minerals we understand well, we have worked with in the past, and that doesn't mean that we are not open to other opportunities, like for example zinc and lead, which this region is quite prospective in those terms. This is an overview of our portfolio, of the types of deals we have done. As you can see, we work with all the stages of mining. I mean, we have very selected investments in different countries across our region. We tend to work with companies at all stages: pre-development, development stage, expansion, because each one of them has
or brings something unique, something different to the context, to the countries where we are operating. What matters at the end of the day is the impact, and that's one of the key drivers of our decision-making process. That doesn't mean we are not commercially driven. We very much follow the commercial criteria that any investor would follow. We look at the quarters, where are you sitting, where is your project operating. But we also look at what else you can bring to those economies where we operate. And maybe this next slide shows you a bit closer, zooms in into the type of engagements we have had so far along the 13 Gold Belt. We have done several projects throughout our history. Maybe the most recent ones are starting with Dundee Precious Metals, just next door to Macedonia. We have invested heavily in their copper and gold mine, Chelpech. We have also done other investments like Krumovgrad, and we have worked with other companies along the Tethyan Belt. What you can maybe extract out of this slide is that each company has a virtue, brings something unique. For example, Dundee, that's the technology, that's the innovation, that's the community engagement. Lydian, that gives us a good opportunity to engage with the local authorities in policy dialogue in respect of the Extractive Industries Transparency Initiative. There are other elements, like, for example, inclusion. That's the case of Tumat and Oxud, that was in Terra. These are companies that are ramping up their inclusion programs, making the mines open to local communities to get skills, to get training. And very much of this potential, we see it also with Euromax. I mean, Euromax is one of our investees and one sponsor of this the previous session. And that's a company that also is characterized for its its commitment to environmental and social stewardship, very much in line and above EBRD standards. Why is mining such an important thing for an investor like us? Well, I mean, we're a development institution after all, so we also see that 6 out of 17 sustainable development goals are very much linked to the mining sector, either in the form of an enhancement, like could be development goals such as infrastructure, innovation, skills, education, or as a mitigation. We think mining is a very important element of the industrialization effort of any country, and there are certain things that have to be taken care of properly, like ecosystems, biodiversity, social engagement. How we developed, and sorry for the crowded slide here, you will probably be able to go more into the detail when you download the presentation, but we have carried out quite a thorough analysis of every mining jurisdiction where we are working and we are intending to work. We have identified several challenges that need attention, some of them more urgent than others. But these are summarized primarily into 4 types. There are competitive challenge, governance challenges, environmental challenges, and inclusion concerns. And for each one of them, we try to select projects that help us address at least 2 of them. In addition to that, this is our investment impact. In addition to that, we also offer technical cooperation. We also assist governments in the jurisdictions where we operate to improve their procedures, improve their regulations, to build the capacity of their agencies. All these are very important things that help us create an ecosystem, mining ecosystem that is functional, works, attracts investment. Ultimately, we also can advocate for certain policies, like what we do in Armenia, where we're a big supporter of the EITI. I was asked to talk a bit about the types of investments or mitigants that a company can implement when it comes to the green and inclusive angles of their work. I just wanted to maybe highlight that we are not naively assuming that mines are themselves green. However, we very much understand that there is a certain risk mitigation that needs to happen in order to build your social license to operate. And you can very much do it using these two elements, inclusion and environment, or green elements. You can, by doing so, you can also mitigate the risk to investors. I mean, there's a very important risk. We have seen it materializing in many of our projects, in projects where we have not worked, and there is a huge value in promoting certain things, certain nudges, certain investments or elements that help build up a good project, what is considered a good project that goes beyond our requirements. I'm talking here about closing procedures, about waste management. I'm talking here also about partnership with local institutions to develop skills of the community, qualification of workers, gender focus. All these are very interesting opportunities.
Francisco, I apologize. We're going to have to speed up. It's
Apologies for that.
No.
Just wrapping up, I wanted just to draw your attention to our environmental policy. This sets the minimum standards. Green and inclusive investments go beyond these standards. What this tries to do is to address an asymmetric information problem. Just allow people to recognize your project as being vetted by EBRD, as being compliant with EBRD policy. Should you be interested in working with us, we can walk you more separately through our approval process and the types of products we offer. Thank you very much.
I'm a big fan of being proactive and not being reactive, so we're going to stop the questions. We'll have the next presenter. At the end, please feel free to come and approach the presenters and share your business card, and they can get back to you individually. If we have some extra time at the end, of course, we'll take questions, but we still have 4 presentations, and we have exactly 40 minutes.
Okay, perfect. Good afternoon, everyone. I'm Silvia Melissano. I work in primary markets team at London Stock Exchange. And as I said before, I'm here today to talk about how mining companies can raise capital through our markets. So, I will move on. Okay, London Stock Exchange, first of all, is more than just an equity exchange. It's formed of 4 businesses, so information services. Capital markets is where IPOs happen, post-trade services, and finally, London Stock Exchange technology. London Stock Exchange is a financial infrastructure and is at the heart of the financial center. It is listed on London Stock Exchange, and our market cap today, it amounts at around $15 billion. One other important thing that I would like to underline is that London Stock Exchange is an international exchange. 9 out of 10 largest IPO in 2017 were international. As you can see, we had Elite Irish Bank, Polius, Russian companies, and Counter Global from the United States. And we continue to see high growth company to access our market. Here again, some successful examples such as Havas, the technology company from Czech Republic, Vivo Energy from Africa, and Energian from Greece. So in these 2 slides, I give you a snapshot of the Russian and CIS companies. Up to date, we had 101 Russian and CIS company, with the last one listed yesterday, Block Energy from Georgia, and a combined market cap of $600 billion. Looking at Europe instead, we have 137 companies with a total market cap of $850 billion. Now I will move on talking why London Stock Exchange could be the partner of choice for metals and mining companies. So in this slide there is a snapshot of the number of mining companies who chose to join our market. We have 172 companies. In the following slides, there will be how these companies are divided by subsectors. with a total market cap of $514 billion. Here, there are the top 10 metals and mining companies that got listed last year. As you can see, there are both AIM and main market companies. AIM is the market for the smaller and with high potential companies. And yeah, most of the companies, all of the companies are from all over the world, with United Kingdom, Israel, Namibia, Brazil, and so on. London Stock Exchange is home of 3 out of 5 largest mining companies, which are BHP, Billiton, Rio Tinto, and Glencore, and has 14% of the total market cap of all listed mining companies worldwide. In the pie chart, we compared the London Stock Exchange with the other important London Stock Exchange, such as the Australian London Stock Exchange, Shanghai, and where you can see other, that is 33%, it is Dubai Financial Market and Abu Dhabi, that have no listed metals and mining company. In these slides, we divided the 172 companies by subsectors. And we can see that most of them, 72, are general mining, followed by gold mining and so on. One of the most important quality of London Stock Exchange it has that it gives access to international institutional investors. So institutional investors hold $152 billion on London Stock Exchange listed mining stocks. And as you can see again, they are international investors. 41% is from UK, 34% from North America, and 15% from Europe, excluding UK, and 11% from all over the world. So since 2018, more metal and mining companies has been raised on London Stock Exchange compared to the other international exchange. London Stock Exchange raised $16 billion in the past 10 years. Listing on London Stock Exchange gives access also to a high liquid market. In these slides, we consider the average daily trading volume, and as you can see, London Stock Exchange leads compared to the other stock exchange. More stocks are traded on London Stock Exchange than, for example, Australian Stock Exchange. It's 6 times, and 18 times compared to Singapore Stock Exchange. Now we look at investors who chose our market to invest their capital. So as you can see again, there is a strong presence from the asset manager community. BlackRock leads this list with a total equity invested of $12.9 billion, followed by other important names such as Vanguard, Public Investment Corporation from South Africa, and Norges Bank from Norway. Again, in these slides, we divided investors by the region, so European, US, Middle East and Africa, and Asia, and we gave you the top 5 investors for each region. Again, here we have some successful case studies, both for the main market, Fresnillo, and for the A market, Phoenix Global Mining. Right now we have, so I'm a little bit short of time. Here in the appendix you can find some numbers of London Stock Exchange that will be sent to you electronically. We had successful here last year with 65% more IPOs happened compared to 2016, an increase of money raised of 155%, and the total market capital raised was $19.3 billion. And it has been such successful here this first quarter with 17 IPOs that happened on our market. So yes, here again are some slides looking more in depth at numbers, and some slides that highlight the AIM framework, the responsibilities of the smaller company who chose to access our market to finance their business. And yeah, the last slide about the IPO process, again, focused more on AIM companies. Thank you today.
So good, thank you very much. We will move on.
Okay.
Yulia, please have your presentation. And please keep in mind, just if we have time at the end, we'll have follow-up questions, and if not, just feel very free to approach the panel. We'll be here for a couple minutes afterwards and exchange business cards.
Good afternoon. I'm Yulia, and I will present you what technical reports you need for IPO to support previous presentation. Okay, brief introduction. What is Ward & Armstrong Group? We are a UK-based consulting company, and we provide a full range of technical services, including expert reports and due diligence reports for merger acquisition, stock market listing, and validation of assets. Let's talk a bit about IPO mining reporting standards. We have many opportunities and choices around the world where we can list our assets, and every place has its own requirement what should be technical standard for your reporting of your minerals and your mining project. Most popular, as we also saw from previous presentations, still London Stock Exchange, and Toronto and Hong Kong, they are also good alternatives, which are getting popular as well. Our company will involved in a long list of IPO process. This is just an example of our projects done for preliminary London Stock Exchange, but also for Hong Kong and for Toronto. So as you can see, we will involve in Glencore and Petropavlovsk IPO process and still ongoing process with Electro Minerals and others. So let's look briefly at what is listing requirements. And we'll take as example 3 stock exchange, London Stock Exchange, Hong Kong and Canada. So all 3, they have some admission unlisted and mineral reporting standard requirements, and common for all of them is competent person report. So you can do whatever reports for your mining assets, but if you want looking for IPO, you need competent person reports, and it's similar for everything. Once you listed your assets for London Stock Exchange on main market, there is no further requirement for specifically for mining companies. On air, resource should be updated by a competent person, and for Hong Kong Stock Exchange, you should do half-yearly updates, and there is no specific field requirements for Canada. There is some similarities and differences. Example for NE 43101 required for Toronto and JORC standard. Similarities are that involvement of competent person is required, more similar definition of mineral resources or reserves, preliminary economic assessment alongside the scoping study, definition of pre-feasibility, feasibility study, and pre-feasibility studies minimum standard for ore resource. So you cannot report your ores using scoping study level. The major difference between these two standards that NE 43101 is a securities law, whereas JORC is a policy guideline, which is prepared by industry professionals, and NE 43101 applies to all oral and written disclosure of material information and highly prescriptive, whereas JORC applies to written disclosure of exploration results and mineral resources. As you notice that I mentioned that competent person report require competent person. Most probably most of you knows who is competent person, but I will repeat that this is actually individual person who has minimum 5 years of relevant experience, and he must be member of professional association. It's this person is
he or she.
Oh, he or she, right? So he should be independent, or she should be independent of applicant and independent of admission result. Not sole petitioner, what's mean it should be a member of professional association, and one CP may sign off a whole report, or individual CP will be responsible for their sections. It's also an important point. What is included in competent person report? So you want to go to IPO, you're making your CPR report, you go into consulting company because you're looking for a competent person who is independent. So what this competent person look for? You permitting, geology, mineralization, resources, mining methods, optimization, processing cost, environmental, financial analysis. So it will be complete assessment of your assets, and CPR should be prepared on all material assets and liabilities of the applicants. So if you go into IPO, you are making complete disclosure of your assets. For a successful IPO, all of above should be managed and reported in a good standard, although exploration project will have disciplines to review. Obvious aim is to maximize your asset value, so you can collect more money after IPO. In reality, the independent consultants provide sort of comfort to both clients and investors that their projects are being managed, developed, or traded to an acceptable standard. What are investors looking for with a project? This is small but not complete lease, so we're looking for economic rate, simple metallurgy, good recovery, simple engineering for extraction, environmental, social licenses to operate, reasonable infrastructure and access, and security and stability in all aspects. That's why CPR report dealing with key technical issues of a project. And as I said, that early preparation of CPR, maximizing evaluation of your project. So it's better, as you think only about IPO, it's the best way to meet your technical consultant as early as possible in the process, so we can evaluate your technical state of your project and give you recommendation how to maximize value of your asset. I will just talk on several key moments. One of them is mineral resources. So we report mineral resources as example according to JORC standard, which is acceptable for London Stock Exchange and for majority of our stock exchanges. And we, what is mineral resources? Mineral resources, this is solid material which has economic interest. And according to geological confidence, it's subdivided in inferred, indicated, and measured categories. Competent person is responsible for this subdivision. According to his knowledge and understanding of project, he will sign the mineral resources. And these three categories is based on amount of your drilling and how well we studied this asset. We can do resource modeling. Okay. Yeah. 2 minutes. Based on, it can be more traditional method or more advanced methods. In recent year we moved more in fully computer-based just statistical approach, but traditional methods are still valid. A brief comment about explorational target. Explorational target can be quoted only a range of tonnage and a range of grades, but it cannot be said as resources fell. Ore reserves. When you move to ore reserves, you implement modifying factors, which is very well known information now. But we always should remember that modifying factors is a big range of factors, including economic, marketing, legal, environmental, social and governmental factors as well. They are modifying factors for you to, you cannot just take your resources, constrain model of mine and say I have this amount of resource. It's big study. Again, we will stop on environmental and social aspects, so to not forget it, because we heard already problems related to this in different countries, including Macedonia, that environmental social performance globally varies from excellent to poor. However, there is an international standard IFC guidelines and equator principle, which is in compliance with most of international finance institutions. Also, for gold mining, it's very good to have cyanide management audit in accordance with cyanide management code. And it's becoming very important for your listing and your successful IPO process. There are several methods. Yeah, I will not speak about valuation methodologies. So thank you for your attention.
One slide. You know what? Please go back. One slide. You can't stop one slide.
No, no chance anymore. Thank you.
I always slide.
Yeah, I will leave it for questions.
But thank you very much. It was a very technical report. But again, if you want to raise financing, and one way of doing it is IPOs, you're going to have to hire someone that's an expert at it. I've been doing this for over 20 years. If you try to save, if you nickel and dime, if you want the best, you have to pay top dollar. That's the way it works. If you want the best advisors, you got to pay top dollar for it. If you want to hire a drill in your company, you have to pay top. If you want a nickel and dime, you get what you pay for as well. It's a very simple statement. And then they bring it through. I think everyone else on the table. Thank you very much.
Thank you very much.
We're exactly actually what's good. Constantine,
good afternoon. I will keep it short, so I have 9 minutes and a half. Thank you very much, first of all, to MINEX to host this edition of Mining Conference here in Skopje. I see a lot of colleagues we've met last year in Belgrade, so clearly this region, Balkan countries, has a lot of potential, and probably not enough investment. Today you have very comprehensive view on the investment or financing options for the companies in metals and mining sector, from private equity to multilateral institutions like EBRD and IFC. You have representatives of LSE. Now I will give you probably a short view from the position of a commercial bank. So I'm part of Société Générale Group, French bank. I'm based in Paris, and I'm part of metals and mining finance team.
Constantine, I'm going to jump in.
Yeah.
The presentation you had last year, I sent you an email afterwards saying that's one of the best presentations I've ever seen. That was a detailed 40-pager.
Thank you.
9 minutes.
Yeah.
And again, it's an outstanding presentation. Don't get lost in the forest. Let's just focus on the big picture. And all these presentations will be on the website. You'll have access to.
Yeah, no problem. I will actually go rapidly through the slides and show you just a practical example of our financing here in Macedonia. So yeah, SG has been committed to commodity markets for more than 25 years. We have quite large team of metals and mining specialists 40, including technical engineers. I think we understand quite well the quality of the assets, and we have quite a global view on the market because we cover different mining jurisdictions out of 8 regional hubs, mainly in Paris and London, but also in New York, in Sydney, Hong Kong, and Dubai and São Paulo. So we can see it actually our regional presence. So we cover all types of commodity producers, metals and mining producers, from projects, greenfield, brownfield projects, to the established producers, trading companies, financial sponsors, private equity funds, etc. So we cover also quite large number of underlyings. So all the steel value chain, aluminium-based metals, bulks, precious metals, fertilizers, etc., etc. So you can see through the different stages of the development of a mining company how we can accompany the client. So starting from the feasibility stage, where we can provide some view on the bankability of the project, next to the arranging and financing facilities for the mainly in form of project financing. So it could be like a greenfield or expansion project, brownfield projects, and then next to the more structured facility solution for the established producers and also corporate facilities. So you will see on this chart just different clients we cover, different types of companies, from copper project in Mongolia or in Tongol. A lot of financial institutions participated, Rocks Gold, a gold mine in Burkina Faso, to, for example, an MNK or Metal Invest or Fortescue, large corporates in different metals or commodity sectors. So briefly, we approach like any other commercial bank, probably active in mining financing, in 3 different groups of financing solutions. So first of them is structured commodity finance, which can be detailed in like different specific projects, but the main idea is they are backed by commodity flows, so mainly for the exporters or for also for the projects. So clearly here the offtake contracts allow us to mitigate the country risk, to get longer tenors, and to improve the pricing conditions. So you have different derivatives of this structured commodity finance in the form of a via trading, trader facility, via offtake facility, or commercial prepaid structure where SG could offtake some precious metals. Or so you have another group of product financing solutions which are part of project financing. So it's a quite typical form of financing for the development project. I think you are aware of that in all details. Probably the main highlights is that such type of financing allows to provide financing on non-recourse basis to the sponsors post-completion, to achieve highly leveraged structures, and also to get longer tenors. And the last group of product is acquisition finance, either in the form of a bridge financing, or it could be financing, asset-backed financing on the basis of the target which is being acquired. And as I have 3 minutes left, I will probably just show you the concrete example of our financing success, I would say, in the country. So we financed together with Investec Sasa mine in 2016. It's one of the largest lead zinc and silver mines in Europe, with 20 years of reserve life, first quartile competitive cash costs assets. This mine is located in northeastern Macedonia. We actually mainly arranged these facilities together with our subsidiary in Macedonia, Ahvidska Banka, and some participation from another mining bank, Investec, which allowed us to achieve 75 million commitment over 7 years tenor. So which is quite good from the international banks for the country. And actually this mine was previously owned by private equity fund Orion, and due to change of control mechanism, which we actually approved, the shareholding of this company passed to another London Stock Exchange listed company, Central Asia Metals, at the end of last year. So I think it's a good example of a mix between bank financing, private equity, and also some involvement of IPO for the company which acquired Sasa Mine last year in Macedonia. So clearly a good example of cooperation of different parties in the market. So for the questions, unfortunately we don't have enough time, but I'm around and clearly we'll be happy to discuss afterwards. Thank you.
Thank you very much. We're actually 1 minute ahead of schedule now, so we'll have our final speaker. And in 10 minutes, please. We've got 1 minute closing remarks, so we'll go to 31.
Okay. Good afternoon. My name is Zoran Martinovski. I represent IFC for Macedonia and Montenegro. I've been with the company for over 17 years. And I would like to thank MINEX for choosing my hometown Skopje for this year's conference. So I'll try to squeeze in within the time limit. So it's going to be more like an elevator pitch than a full presentation. So before Robert cuts me off, I'll try to summarize the main points. So who we are? IFC is part of the World Bank Group. We are the private sector arm of the World Bank Group. We provide financing and advice to private sector companies and banks worldwide in emerging markets. And in that respect, we are the largest multilateral source of debt and equity financing in emerging markets, with a total committed portfolio of about 55 billion, I believe. We are owned by over 180 countries with AAA. As part of our overall development mandate, we promote world-class social and environmental standards. And we have a presence in more than 100 countries in the world, and most of our staff is based outside of Washington, where is our global headquarters. So, as you can see from this chart, mining represents less than 4% of our total historical commitments. But mining has been probably one of the most profitable sectors for IFC. So one of the sort of messages which I would like to deliver is that, yes, mining is a very risky business, but if you do it right, there are some tremendous upside risks. And over the past years, we've learned, both, the hard way, and so we've experienced different scenarios. So yes, it's very important who you partner with and in what type of projects you get involved. Back to the point of what my colleagues said, you have to be very selective when it comes to mining, because there are very few really good deposits around the world, and since we are a global institution, we are extremely selective. Unfortunately, this part of the world and Latin America is represented with less than 1% from our total commitments. You'll see that in the next chart. So when it comes to IFC Integrated Solutions, what do we do? On the investment side, we provide long-term loans, we provide equity instruments, quasi-equity trade finance syndications, risk management tools, capital market access. We also mobilize third-party investments. IFC has a wholly owned subsidiary called AMC Asset Management Company. It's a $9 billion operation, which co-invests alongside IFC worldwide. On the advisory side, we provide firm-level advisory, but we also do PPP advisory, public-private partnerships, and together with the bank, we work on the improvement of business enabling environment for the private sector. Yeah, I'm going to skip all of this. So we get involved across different stages in mining business, exploration, pre-development, development, and production. And here we've learned basically that in each of these stages it's very important the moment you choose to get involved and exit. What clients value, why they're partnering with IFC? I mean, first of all, IFC provides a long-term capital which is not readily available in emerging markets. That's number one, at affordable terms. But it's the stamp of approval. It's which can be a very important risk mitigation tool in difficult times. Since as a global development institution, we share with our clients our global expertise, which is not very typical for financial institutions. We have an in-house expertise. We have engineers with long years of experience. So, which our clients value. We've had cases where, basically, thanks to our sort of technical support, basically projects took off that otherwise were facing difficulties. And then, of course, affiliation with the World Bank Group helps. We have direct relationships with our partner governments, which also helps. As mentioned before, our committed portfolio as of 2017 was about $1 billion in more than 20 projects in about 15 countries. And by commodity type, you'll see that copper has been by far the most sort of represented in our portfolio, followed by bauxite, and it's not on this chart, it's also iron ore. But precious metals in general, we've done well in precious metals. And by region, as I said, Europe, Central Asia, and MENA, less than 1%, same for Latin America. By far, we have the largest exposure in East Asia and Sub-Saharan Africa. Here are some few case studies that you can take a look later on. The organizers will share the presentations from different geographies. The countries marked in dark blue basically is where we have presence and active projects across the world. Our mining hubs are presented here. Basically, if you're interested in support to your projects in this particular part of the world, you may contact our London office, and my colleagues listed there, Sasha, Ignacio, and Stefan. They can provide specific information on how we could help you.
Just quick, what was the strategic engagements? Neil, what was that?
Strategic engagements means that we look for long-term partnerships. Basically, we look for repeat business with the same pool of clients. So basically, we have strategic partners with whom we've done multiple projects in multiple countries.
Easiest person to lend to, someone you've lent to before. You already have a relationship with
Of course, yeah, right. And then, you know, the second and third, I mean, it's always the, you know, the first project is the most challenging one. Later on, when you know your client well and when they know basically what they can expect from you, it's relatively easier. I would like to sort of spend a minute or two basically on IFC performance standards. The theme basically of this conference was environmental social risks. Few presenters before mentioned how important are these sort of non-technical aspects of mining. And I would like to stress that basically IFC has been helping clients to mitigate risks by adopting our world-class standards that have been adopted by most of the banks in what was mentioned before, the Equator principles. Initially it's hard basically to deal with all these aspects. Clients complain about how sort of detailed we are and maybe too rigid when it comes to compliance with the standards, but long term, they pay off. And oftentimes we help clients go beyond compliance so that they can address the issues which are not apparent at the moment, but then they might become, very important later on as you move on with your project development. And up here I would like to mention, some few anecdotal examples. Again, I'm not a mining expert, but I've been involved over the past years in some mining projects in these non-core activities. And I recall a project in Peru, Yanacocha mine, where actually there was a major, environmental incident where IFC actually went over, mobilized, third parties, and provided an integrated sort of package of products that involved, linkages, community development programs. It involves, capacity building for the local municipality that provided sort of services that have been missing in that part basically of the country, so that basically you ensure local support, which is very very important. And another it's mentioned here, cultural heritage, indigenous people. I recall a project in Africa where actually there was a graveyard, so basically, and it was right at the project site. So basically, these graves had to be removed, but it was not possible to do before consulting with these people basically which were there. So we hired a consultant. It was a medicine man basically who had to speak with these people and then got their permission, and then literally we did that, and it worked, and the project succeeded eventually. So again, maybe they look a bit funny, but they are very important risks. So that's about it. I would stop here, maybe ahead of the time, 30 seconds. So thanks a lot for your attention.
Thank you very much. Actually, that last slide, I just wanted to close up. First of all, I'd like to thank all the presenters today. I thought it was outstanding. And again, please feel free to approach us afterwards. That last slide, actually, I just wanted to make one comment. And we talked about economics and financials and everything. I have a mining engineering degree with a focus on environmental management that was partially sponsored by the World Bank and the IFC. These guys walked the walk and talked the talk 25 years ago. I just want to make 2 points. One on human capital, and again, this is from the PwC report. Employee compensation was up 5%. This is a sector that actually does compensate people that work for it. And number 2, the more important number, fatalities were down 36% last year on year. So we're getting better and better. And then my final comment, I think everyone here knows what CSR is. And at Capital, we don't call it CSR, we actually call it last year, 27% of new board appointments in the sector, in the top 40 mining companies, were women. Okay, at one point. Number two, of the female representation on boards, it's 19%, almost 1 in 5. And my third point on that is partnerships with local communities are increasing. For some reason, which I still haven't understood, and I talked to the CEOs of the top mining companies in the world, and the top steel, the mining steel sector does a really bad job of PR work. For some reason, we're not, hopefully we'll turn off the video at this point, we're not a chemical company up the river from Manhattan and polluting into the Hudson River that goes into the water that goes into Manhattan, where I lived for a number of years. These mines are located in the middle of nowhere, one. Two, they create jobs for people in the middle of nowhere that don't have jobs. If the community is smart, they'll actually use those, part of the money that goes into the community to educate the children, so they're educating the children can either stay in the community and create more jobs or go to a larger city. They have it whenever you come to the big cities. So the only thing you really bring to the table is education, unless you're rich. And so just as a final point, one of the things that I'm going to try to, over the next couple of years, and Next Capital is going to support me, is actually go out there and say, we're good at what we do. One in five. Our sector has 1 in 5. For the top 40 companies, 1 in 5, and that number should be 1 in 2.5 in the next 5 years, hopefully. Thank you very much.